Welcome. Today we're looking at our Q1 outlook for data center equipment manufacturing, one of the largest manufacturing sectors that we believed is poised for high growth following the exponential growth of data centers in the US. This AI infrastructure boom has fundamentally broken the old playbook, and our core thesis this year is simple: it's bifurcation. So the one-size-fits-all location strategy where you follow your customers is broken to some degree. Now we're looking at competing strategies. So we have strategy A, which we call speed. These are for manufacturers of things like IT systems, where the need to be within close proximity to hyperscalers will be critical. Our strategy B, we title resilience, and this is going to be more for manufacturers of things like heavy power and cooling infrastructure, where the need for raw material access, stable utility loads, deep manufacturing talent is going to be the more critical aspect. When you look at the chart, you can see that the types of products and the types of equipment going into a data center are diverse. By default, the location needs of these types of manufacturers are going to be diverse. Different logistics requirements, different talent profiles, different risk profiles, different site requirements, and all of this is going to create the need for a bespoke location strategy and site selection requirement. We also have something interesting going on in the market right now. We're calling it the power wall. And so legacy hubs like Northern Virginia, the Silicon Valley, they're really hitting a wall on transmission capacity. And you see data centers now are starting to look at tier 2, tier 3 markets as they're really tracing power capacity. As data center equipment manufacturers, there also need to be cognizant of where these new hubs are starting to grow in the US and how to adjust the supply chain considerations around that. When we think about the supply chain, we're thinking about a hub and spoke network. And so we'll have our heavy hubs, which will be places like the Midwest, Mexico. This will be where companies are consolidating capital intensive manufacturing, places where labor is going to be abundant, steel and other raw supplies are local, power is stable, etc. We'll have integration spokes. These will be places like Phoenix, Columbus, Reno. These will typically be for final assembly facilities. They're going to be well positioned for that 4-hour trucking window for the hyperscalers. There'll also be the need for risk mitigation, the diversification of your port of entry. These will help with delays as you have products coming from outside of the US. From a global perspective on the supply chain, sovereign risk is back bigger than ever. With rising Section 301 tariff exposure, reliance on offshoring is riskier than ever. Domestic US capacity is now the only safe harbor for critical covered infrastructure. The regional ecosystems, we're seeing a split. So the industrial Midwest is winning on water security, stable baseload power for heavy fabrication, while places like the Southeast are winning on the logistics velocity, though it's facing a lot of labor pressures. It's seeing tons of inward investment for manufacturing across most of the Southeast for many, many years now. We're also seeing a need to be sensitive to jurisdictional profiles. And so really what we're finding is you're going to need to match your particular project to the state's investment archetype. And so, for example, you're not going to want to chase cash grants in speed and deregulation markets. We want to align capital stacks with the local incentive mechanisms to make sure that we've got overall alignment in the near term and long term on that front. Utilities are another consideration. We're going to see a wide variation on utility costs and reliability across the US. States offer different power solutions, different time to power, different reliability, and different costs. And so companies are going to have high utility requirements, are going to want to really look beyond the rate and also look to the reliability, the transmission capacity, and also the time to be connected to power. Labor, probably one of the last items we're touching on, but one of the most important. The number one risk for U.S. manufacturers in this year we think was going to be talent. As an example, the Southeast is seeing wage inflation due to the high volume of automotive manufacturing that has gone into the area. Coastal hubs, in contrast, they have high engineering talent, but low trade density, low manufacturing density. They're high cost. Right now, we're seeing that the Midwest offers that sweet spot of high-skilled trade availability. It's still a moderate cost structure, but these are still competitive markets. We look at the total cost of operations, we can see really wide variation across the US. And a lot of this is going to be based on that composition of what your talent requirements are, your utility requirements, the land, the building, and how much we're building. And all of this is going to go into that composite look at your total cost. But you look at the traditional data center hubs, the Silicon Valleys and Northern Virginias, they're just pricing themselves out of manufacturing, really haven't been doing core manufacturing for many years now. And we look at places like the Midwest, we're still managing moderate cost in comparison. When we think about the strategic decision framework, there's a couple of priorities we're seeing. So the first is we de-risk the supply chain. The second is prioritizing power. That's going to be both impactful, not only the data centers, but the equipment manufacturers as well, and also prioritizing the talent aspect, really understanding how to avoid the supply and demand continuum where the demand for talent is way outstripped the supply, looking for places where you still can find that deep manufacturing legacy, but at still a lower cost compared to some of the traditional manufacturing hubs. Those are our predictions so far in Q1. We look forward to updates